of what's being selected. You can see at the back end of 2019, these were the best ideas of stocks across hedge funds, and it'd be easy enough to check how these have performed. I should declare I own MasterCard out of that list and not the others. So we'll see how they've done. But I'll update this and share a new list with you in due course once I've got it for what hedge funds own. But what I thought I'd do in this quick presentation is take you through some of the other things that I'm seeing in terms of who's buying what and some of the best ideas that are crossing my desk. So like I said, what I want to share is, like I said, I see a lot of stuff during the course of the year. This was from back in April, and you get it from Goldman's, UBS, and everyone else. So I just want to share some of the things that I'm seeing with you at the moment. Okay, and how they've panned out and which stocks particularly look interesting. And where I've got all my information from for this quick live presentation is, as I said, a variety of sources, not just what the big banks are showing, not just as I showed you in the earlier slide, what the hedge funds are going into, and Goldman Sachs as well. So there's a whole bunch of sources, and where I get an overlap, where I keep seeing the same stock mentioned over and over again, and then I look at the financials of that stock and I look at its valuation, its revenue growth, sales growth, dividend yields, its average performance, its volatility, its cash flow and cash flow growth, then I have a pretty good idea of which way things are going. Now, I've got a message regarding LinkedIn that they can't seem to see the presentation. They only see the audio. Should hopefully be showing the presentation as well. Apologies if on LinkedIn it isn't, but I will describe what I'm seeing on screen in any event with you. And for those who can see the screens, what you should be able to see right now is a list of the S&P 500 stocks, but gravitated towards the ones which are the most popular with the biggest funds. So whichever are the most popular with the biggest funds have marked in the darkest green. So again, it's that principle of overlap. Which ones keep coming up, and you might have well seen darkest green, but and some of you might only be getting the audio. But what you should, I'll tell you what's up on screen is United Healthcare. I didn't know about United Healthcare until earlier in the year, and then that was the starting point. What keeps coming up? Which is showing up in the biggest funds like Berkshire Hathaway's funds and so on. Then you got Amazon, you got Berkshire, you've got Booking, Fox, Viacom. Viacom's been great since around April time, CVS Pharmaceuticals, Wells Fargo, so on and so forth up there. And that then allowed me to put those names into a filter. I have a very simple rule, 12, 25, and 15. What that means is 12-month holding period. If a stock drops more than 25% from the highest it's been since I bought it, I'd get out. And 15 stocks roughly is enough for a diversified portfolio for a private investor anyway. Rough and ready, that will be fine for you, okay? So those are some of the names which came up from that analysis. All right, well, that's fine. That's from that analysis. What else have we got? Well, obviously, a lot of people are talking about Biden and which stocks they should be buying now. Now, I'm going to give you a word of caution here. Yes, there are 52-week highs. I was just looking at some of the 52-week highs we've got. You've got Tesla, PayPal. Okay, 52-week high in PayPal. Now, it's one of the ones I bought from earlier in the day. Comcast, I didn't have. Tesla, by the way, I don't have. Nike, I have, and that's at a 52-week high. So AbbVie, I own, and Costco, I own. So the issue then becomes, well, would you still own these? I mean, these are multi-billion-dollar companies. Nothing I say to my audience now is going to change those stock price movements from you guys buying them or whatever. But the point is, now what? If we're already at 52-week high, and these are not just tech stocks. Costco isn't tech stock. Nike isn't a tech stock, although it's what they're doing in digital, which is boosting their returns. Going more online and being good at that is what's boosting their returns. Okay, so now what? We've got those 52-week highs. Well, I've always said, particularly if you're watching this out of the UK, you need to expand. This is my column from 1999 in the Financial Times, back in 1999, okay, guys? And what you can see in the red box, so you might not be able to see, let me see if I can zoom in, okay? And what I've said back then is why, despite being in the UK, I own a lot of American companies, and that's in 1999. You can just look at what's happened since then in the US markets to know, well, how am I doing? Well, you know, that'll tell you. And there's proof of it from that column back on September the 11th, 99, as I said. That's why I'm particularly focused on some of these US companies, because it's not a new thing. Okay, been doing it for 21 odd years to know it is not a new thing. It is not a fad, and it is what has led to some of the better returns. So what are the names? Like I said, I still own PayPal, still own Nike, AbbVie, and Costco. Well, that's fine. That's some names I've just mentioned. My job, very simple. And the job of any fund manager, convert you can call it $10,000 into 3 million. Okay, it's as simple as that. And if you look at your Amazons and your Apples, yeah, but you know what the problem is? People foolishly assume that you're just going to hold it for 15 years. Of course you don't. That's why I said in my 12, 25, 15 rule, it's a 12-month period, then review. There have been 12-month periods when I've not had Amazon. Why? Well, because it's done nothing and it hasn't looked good financially. In 2005, for instance, 2006, it didn't look great financially. Okay, and guess what? It only went sideways. 2008, when the rest of the market collapsed, it was a flight to quality stock. It still dropped. Okay, so it's not that you're going to buy and hold forever. You're going to hold for 12 months and review. Same with Apple. People go, oh, if you bought Apple back in 1999, when I wrote that column and started buying Apple, I didn't hold it all the way through because there were periods when it wasn't doing anything. Such as in 2001, 2002, 2000 with the tech crash. Nobody was holding tech stocks in 2000, which is why there was a tech crash around March time anyway to begin with. So the point is review over 12 months. Like I said, market milestone, well, stock market, strong gains in November. November was one of the best months ever. And what we're seeing at the moment is not just the Dow, which is just 30 stocks. Look at the Russell 2000, which is 2,000 companies. There is more of a short-term focus into value and small cap value. I do not gamble on the capitalization of a company or on a style such as value, growth, income. I want all of it. I want all of it. I want companies which are generating cash flow, are well-valued, good growth companies as well. In other words, I don't just want value companies or momentum or growth. I want value, growth, income, momentum. I want it all because I've only got to pick 15 always. Anyway, I've only got to pick 15. Okay, if I've only got to pick 15, then why can't I be picky? It's a bit like I've always said this. I'm not racist when it comes to picking stocks. Okay, I'm not racist when it comes to picking stocks. I don't care if they're Chinese companies, Indian companies, British companies, or American companies. What I care about is can they deliver the strong growth, consistent cash flow? The term I use is CROCI, which is developed by Deutsche Bank, used by Goldman Sachs Asset Management to tell their wealthiest clients which stocks are going to perform most. It's a measure of cash flow generation. Okay, and I want them to be growth, income, value. I'm interviewing 8,000 global companies, and I want 15 to make it to manage my son's inheritance. All right. So guess what? I'm bloody picky when it comes to those. Now, going forward, which have been the Dow's November winners. Now, this is just out of interest. The other thing I want to say with this is you've seen Boeing rise up 45% in November. I do not gamble on companies which have been collapsing in their share price in the hope they might turn around. You might make money doing that. You might be lucky. You might make money playing the lottery. If you want to gamble on which companies might turn around, go to Ladbrokes. They'll take your money. They'll give you better odds than the stock market ever will. Okay, I do own American Express. It's not been a gamble. It's not been a gamble. If you followed me from all my webinars this year, you'll know I own American Express. I also own Disney, Goldman Sachs, Cisco. I've still got some Cisco. Visa, Nike, I've already mentioned. Walgreens, which have been doing pretty poorly until last month, actually. But United Healthcare, I already mentioned. Okay, that's just 1 month returns on some of those. So how were they picked? Like I said, do the names keep coming up? And were they falling under valuation, growth, income, cash flow, and every single one of those? Thank you very much, Samira, my friend. I hope you're doing well. So let's look at S&P 500 index average annual returns. What is a split Congress good? Well, first of all, we don't know if the Congress is going to be split. The reason the markets had rallied is they thought the Republicans were going to take control of the Senate. That's not decided yet. Okay. And the idea was that would temper Biden's more left-leaning, i.e. anti-tech, anti-corporate profit policies because Republican Congress would block him. Well, it might be a Democratic Congress, but if it's a narrow one either way, it might not make much of a difference in terms of legislation going through. But what's interesting is this part. What's interesting in all of this is this part. A split Congress does a bit better than a totally unified government, but not much better. Not much better. The worst thing is Congress of one party and president in another. Okay, so anyway, we should be fine, regardless of whether the Senate is Republican or Democrat in any event. And by the way, the most the most right-wing leaning Republican Democrat will probably be on the left wing of the left wing of the Democrat. Sorry, the most left-wing leaning Republican will be on the left of the Democrat. You know what I mean. Okay, debt. Should we be worried about debt? Another factor which people keep asking me, and something which has come across my desk. Public debt to GDP. Well, actually, most countries are much of a muchness. If you follow Japan, you've got a long way to go, and we'd still be fine. It's what, third largest economy in the world, and it's got 270%. The key issues here are, key worries obviously are financing. You know, you got to be funded. Well, interest rates are low. That's the old thing people keep mentioning. Interest rates are low. Don't worry, don't worry. Well, what about traditional economic theories like crowding out? Public sector gets bigger, so the private sector gets crowded out. Surely that'll be bad for stocks and eventually will lead to inflation, higher borrowing costs because they're all competing to borrow money in the same market pool, and therefore companies will find it more expensive to borrow money, and therefore stocks again and profitability will get hit, etc., etc. Well, here's another theory for you, and economists love theories. Here's another theory: crowding in. What if government spending can lead to greater investment, greater job security? What if there is a phenomenon such as crowding in? Anyway, whatever the answer is at the moment, the US stock markets anyway at a near 100% debt to GDP ratio are making all-time highs. So for the moment, and again, why I only look at 12-month holdings and not any longer or shorter, is at the moment we're fine. And where are we in the world in all of this? Well, 1 month global stocks, you can see them on screen. Hopefully everybody can see the screen on LinkedIn or wherever else they are, Twitter, Twitch, YouTube. The 1 month global stocks, and this has been their performance. And these are every single global company listed in the US. Why only the ones listed in the US like Alibaba? Well, because I prefer owning global stocks through a US listing because I trust the US regulator. You might think I'm a fool to trust the US regulator more than the Chinese one, but there you go. Okay, so these are the global companies and how they've done. But I still, whether they're global or UK or US or whatever, I still got to pick them based on the same factors I mentioned: valuation, growth, income, momentum, cash flow, volatility, and average returns. Okay, and I'll give you some of the names which I like, and I've already mentioned some of the ones. But anyway, some ones that I still continue holding, and there's the obvious ones: Amazon, Facebook, Microsoft, Apple, and Alphabet, or Google. Visa, I own. MasterCard, I own. Square, I own, which has been phenomenal. Target, I own. PayPal, I own. American Express, United Healthcare, I've already mentioned, I own in that list. Now, it is not meant to be a tech bias list. I care what generates me a return. That's all I care about. Is it going to make me money? Is it going to generate me a return? That's actually what I care more about, okay, than anything else. And those are some of the names which have come up as a result of that. And you might say, well, too complicated, Alpesh. Why not just index trackers? Well, I already told you the rules are very simple: 12, 25, 15. 12-month holding, 15 stocks. If they drop more than 25% from the peak, you get out and you review and you redeploy your capital. Why not index trackers? Well, here's a good example of a reason why not. An index tracker, of course, will ensure you don't underperform the broader market. But if the broader market does poorly, then it will keep you out of the kinds of stocks which are doing well. And I don't want to do that. Okay, I don't want to do that. So that's a very simple reason why not. Index trackers. What do I therefore do? If I was going to summarize it in one box, you can see it over here. It's looking at the individual companies. I'll try and zoom in. There you go. Let me zoom in. Looking at the individual companies and then looking at valuation factors, momentum, growth, okay, overall, which will give me a quality scoring, right? And it's scoring. It's scoring. You're scoring that as you would score anybody else if you were interviewing them for a job. You would score them on certain criteria, and that's all I do. I'm just scoring them on those criteria of valuation, growth, income, momentum. And I told you, guru ownership, do the big funds own them? Is there consistent overlap? And that narrows it down, and makes my life a lot simpler. One final thing that I also base all of this on is I look at the statistical performance. Over a 250-day period, because we're talking about investments, am I like on average? Is the bell curve basically got a high peak? Has it got a strong average return? And is the volatility, the deviation, the standard deviation from that average return in such a narrow group and of such a difference that I should pretty much be assured of a good return? Now, the past is no indicator of the future, but at least this will narrow down the number of stocks which will have that kind of bell curve distribution. So name me names, okay? Microsoft, Dollar General, and Costco. fit very nicely into that bell curve, right? They fit very nicely into it. It's not the only reason you buy it. All the other reasons that I've given so far in this live broadcast would also be the reasons you own it, but that's a critical one. If you want to learn more about all of this, I've got a lot of free material, including a free copy of my book on alpeshpatel.com, alpeshpatel.com. But this is a critical factor to success. Once you've simplified it, guess what? You're not spending a lot of time on your portfolio, which of course is no bad thing. You don't want to. Essentially, what I do, or what a Goldman Sachs might do when they give, clever names like Goldman Sachs Sustain, is we're both doing the same thing. We're looking for the sustainable leaders, which will give a good return on capital, management quality, and leaders in their industry. We're just approaching it from different ways. It's a bit like religion. They've got theirs, I've got mine. We're both going to reach nirvana in the end in either of our approaches. So hopefully that'll give you a very quick understanding of what it is people like me do and how we use hedge fund data. For those of you who might joined a little bit late, in reverse order, I look at the distribution of the returns. That'll ensure that I'm not panicking if after 20 days something's down 29%. And this is Microsoft, but it could have just as equally have been Costco or Dollar General. Okay, I want to score by value, momentum, growth, income. I don't trust the index trackers. And the reason, like I said, I don't trust the index trackers is I'd be handcuffing myself to one particular style, just the index. Why would I ever want to do that? Okay, wouldn't make sense. I want to hold, remember, 12, 25, 15. 12-month holding, 15 stocks. I'll give you ample that'll give you ample diversification, and if it drops 25% from the highest it's been since you bought it, you'd get out. Why? Because that protects some of the profits you would already have made, and it prevents you being handcuffed in for too long. Okay, but keeps you in long enough that you don't equally hold onto a stock while it falls off a cliff, right? These, as I already showed you, were the 1-month US stocks. And how they've performed in the US markets over the past month. We know it's been a good month, but out of these, I've mentioned which names I already own. And these are the global ADRs listed in the US. And I've mentioned which of these, out of these, I own. Petrobras. If you followed me back in April, it was when we first got into that, the Brazilian oil company. What the hell, Brazilian oil? What's wrong with you? Well, it showed the financials: value, growth, income, momentum, cash flow, VGIM, C, okay, and narrow volatility, high returns. I'm not worried about debt, not just because interest rates are low, but I think there is a concept of crowding in where government can help sustain returns without crowding out the private sector. We don't know whether the Senate's going to be mixed or not. Whichever way it goes, it's not bad for stocks, whether it's a unified government and the Senate becomes Democrat, or if the Senate becomes Republican, it's okay. In terms of those returns, these were the Dow winners. Just to recap again everything that I've said for the latecomers, these were the Dow winners last month. I own American Express. I do not take gambles and bets on companies turning around like Boeing. Okay, good luck to you if you do. Like I said, Ladbrokes is a better place for you. I own American Express, Disney, Goldman Sachs, Cisco, Visa, Nike, Walgreens, and United Healthcare. I did have Caterpillar a while back, and again, it was all based on valuation, growth, income, momentum, all the factors that I've said. And whilst the Dow has had one of its best months ever, you'll notice that the Russell 2000, the smaller value companies, is doing particularly well. Well, I don't gamble. I do not gamble on market cap or investment styles such as value growth. I want it all. If they're making money and give me a return, I don't care if they're value or if they're income. Fund managers who are trying to sell you different types of funds will say, oh, we've got a Japan value fund. We've got a European growth one. Don't fall for it. Why would you geographically limit yourself to a particular investing style? You're handcuffing yourself. The only people who will do that are fund managers who want to flog you some more stuff. Okay, like I said, my job, turn every 10K into 3 million. Why? Well, that's what the Amazons do, but we don't buy and hold it forever. Nobody ever does that. You hold it for 12 months and you review. And that's why there'll be 12-month periods, even with an Amazon or an Apple, where you don't have it because it wasn't a good company. I'm sorry, Amazon was not a good company in 2006 or 2005 or 2004. They just weren't worth holding. Why? Because they weren't generating any bloody returns. And Apple, for more of its life than less, has not been a good company whose stock to hold. It's only been for limited periods of time that it's been a stock worth holding. Okay, that's why we review, and I've said this back in 1999, as I said in the FT column, for that reason. And you can see if I can zoom in, you can see me saying it there, that I want to be holding US stocks. In the last 21 years, guess what? It's my sitting on my hands, which has made me far more money than the meetings, the flights, the running around here, there, building anything. You know what's made the most money? Sitting on my hands with some of the US stocks that were owned. Why? Well, because guess what? It so turned out that Amazon and Apple were better than me. Who'd have thought it? But we all bet on ourselves. Well, perhaps we should bet on some of these companies and the people they employ instead. Okay, thanks, Tony. Hey, Tony, how are you? Thank you, Tarun, as well. Glad you're liking it. And like I said, whilst we've got 52-week highs in some of these, that does not mean I'm chasing momentum. I do own PayPal, I own Nike, AbbVie, and Costco. Tesla, I know Goldman Sachs have just upped their target for it. Tesla is actually too volatile to fall into my portfolio because I have a volatility limit. All right, if you don't have a volatility limit, if that circuit breaker is off for you, feel free to go to Tesla and Bitcoin. But I have a volatility limit, so I don't have those. Okay, and that was the context regarding Biden. This is the S&P 500 for those who missed it earlier, and which of the big funds own which of the stocks. The United Healthcare, Amazon, Booking, Berkshire, they're owned by most. That's how I got my hands on United Healthcare, because I didn't know it was so popular amongst all the big hedge funds and Berkshire Hathaway and Bill Gates and all those kind of people. So got into it and then looked at the valuation, growth, income, momentum, everything fit. And the last thing I look at, and the last thing you should look at, but so often it's the first thing private investors look at, the last thing I look at is what the hell the company does. Why? Because companies have great stories which will seduce you into buying their stock. That's why it should be the last thing you look at. What most people do is they look at what it does and say, oh, that sounds an interesting story. Oh, and a journalist wrote this. Listen, if you want to pick stocks based on what journalists are telling you, then you really should sack your fund manager and just give your money to a journalist. It doesn't make sense, does it? Anyway, that's the end of that one. As I said, I drew all this information from a variety of sources, from UBS, Goldman Sachs, all of these reports which go through my desk, or across my desk, as it were. And I started off with this, and I'll end with it. These are the best stock ideas across hedge funds at the end of 2019. I will update this in a future broadcast as soon as I've got the 2020 list for 2021. So at the end of last year, these were the ones they were getting into. Of these, the only one I owned was MasterCard. We'll see what the equivalent is. These are supposed to be the best ideas. I still will vet them and stream them for valuation, growth, income, momentum, and all those things. If you want a free copy of my book, my Investing Unplugged book, which is somewhere, there it is, over my shoulder, go to alpeshpatel.com and you can download it from there completely for free. I want more people to be able to invest, because investing is where you're basically cloning yourself to get somebody else working for you. And the great thing is that other person, your portfolio, which is working for you, is hiring Amazon and Apple and MasterCard, their employees, to work for you. That's why I love investing so much, because it means you're more efficient as an individual. Okay. So anyway, that's why the book's for free now. It's an international bestseller. And I thought to myself, I can forgo the royalties to make sure that education gets out everywhere else. Okay, thanks, everyone. I'll do more of these. If the feedback is positive, I will do all these. Marek has asked a question. Oh, feel free to ask questions. I've seen some questions popping up. Marek asked a question. Is there an opportunity to invest in companies taking advantage of blockchain? There's two areas here. There's obviously the listed companies, but I suspect you're talking about private companies. If you talk about private companies, have a look at platforms like Crowdcube, okay, which have blockchain and a bunch of other companies. What I tend to do on those angel investing crowdfunding platforms is look for ones which are overfunded, ones which are really popular, and then obviously look at their financials and look if everything makes sense. Remember, it's very high risk, is angel investing crowdfunding, but you'll find some blockchain ones there. And the great thing about the crowdfunding platforms is they commoditize the presentation. They make them uniform, they bring them up to scratch, and you've got to be of a certain quality to get there. So I think it removes some of the risk, not all of it, some of the risk. So that's a good place to go. Suraj, my pleasure as well. Again, Marek, Mark, everyone else, thank you very much. I'll do more of these sort of ad hoc live ones in the future. I think they've been popular. It's been a popular one. So thanks everyone for watching. Thank you.